India's semi-formal and informal segments currently operate with an unmet credit demand of approximately 84 lakh crore rupees. Traditional commercial banks struggle to service this demand because these borrowers lack formal credit histories and standard documentation. To bridge this gap, the Reserve Bank of India created a specific structural framework, the Small Finance Bank. Equitas Small Finance Bank built its entire strategy around this demographic, focusing on the unserved and underserved segments that larger institutions typically ignore. Their primary vehicle for this is the Small Business Loan, or SBL. This is their flagship product, operating with an average ticket size of 9 to 10 lakh rupees, directed at micro-entrepreneurs. Underwriting these loans requires specialized field capabilities. Instead of standard tax returns, field officers assess a borrower's daily cash receipts and inventory turnover to calculate a repayment capacity that traditional paper-based audits miss. This chart displays the bank's asset mix in motion. To mitigate risk, Equitas is compressing its unsecured microfinance exposure, placing a hard cap of 10% on the portfolio and filling the remaining space with secured collateral like small business and vehicle loans. With that secured base established, management has issued guidance projecting a 20% compound annual growth rate in total advances heading into FY27. Alongside that volume, they are targeting an exit return on assets, or ROA, of 1.5%. Executing this relies on scaling their Equitas 2.0 digital platform to lower customer acquisition costs. If they hit these metrics and maintain compliance, management plans to apply for a universal banking license. By cutting unsecured exposure and scaling collateralized loans, Equitas has transitioned from a microlender into a secured loan engine seeking formal banking scale. In the public markets, Equitas currently commands a market capitalization that fluctuates between 8,900 and 10,500 crore rupees. This dashboard illustrates their Q1 FY27 results. The bank transitioned from a 224 crore rupee loss in the previous year to a net profit of 184 crore rupees. The primary engine driving this recovery is net interest income. Their NII reached a record high, surging 31% year-over-year to cross the 1,029 crore mark. The 3-year performance trend confirms this trajectory. The bank has maintained a 17.6% revenue compound annual growth rate, while sustaining operating profit margins at roughly 16%. Those margins are being protected by liability management. Despite a high interest rate environment, Equitas is holding its cost of borrowing to 6.94%. On the asset side, the heavy provisioning that caused previous losses has cleared. Gross non-performing assets have dropped to 2.42%. After provisions, net NPAs stand at 1.12%. This cleaner loan book is allowing their net interest margins to remain at approximately 9%. When evaluating a bank's stability, traditional working capital ratios don't apply. Instead, we measure liquidity using the CASA ratio, current and savings accounts, and the liquidity coverage ratio. Due to industry competition for deposits, the bank's CASA ratio has dipped to 25%. However, their liquidity coverage ratio remains at 160.9%, well above regulatory requirements. With the normalization of provisions, the bank's core operating income is finally reaching the net earnings line. This operational recovery creates an immediate pricing paradox. Based on its current share price, Equitas is trading at a trailing price-to-earnings multiple of roughly 83x. Comparing Equitas against peers, Equitas sits at an 80 to an ETS PE, while AU trades near 27x and Ujjivan at 15x. For return on equity, Equitas generated 1.68% versus AU's 14.5% and Ujjivan's 13.5%. But on price to book, Equitas is priced reasonably at 1.39x versus AU's 3.98x. The market's logic is forward-looking. Investors pay a premium because they expect forward profits to normalize as heavy provisions clear. Validating that trust requires forensic accounting checks. First, we confirm the loan book is granular. Equitas has zero single customer concentration risk. Their revenue is distributed across thousands of small borrowers. Next, we audit the auditors. No abrupt changes on record and no unusual fee spikes. The quality of their earnings is mathematically sound. Their operating cash flow is driven by core net interest income. It is not driven by obscure accounting adjustments. Finally, the shareholding pattern eliminates a key governance risk. The promoters hold 0%, meaning there is zero risk of pledged shares. Meanwhile, domestic institutional investors hold 51.26%, and foreign institutions hold 15.7%. With a forensic baseline this clean and significant institutional capital anchored in the stock, the market is looking past the trailing PE to focus on forward growth. Over 52 weeks, Equitas consolidated between 74 and 77 rupees, forming a bullish symmetrical triangle breakout. The price finds support on the 20-day and 50-day moving averages. Crucially, the uptrend remains intact as long as it holds above the 150-day moving average floor. However, technical momentum is fighting systemic industry gravity. Right now, there is a fierce war for deposits against larger commercial banks offering aggressive yields. Above the deposit war sits regulatory risk. The central bank is maintaining a cautious stance on all unsecured retail lending. This regulatory environment is the reason Equitas is preemptively capping its microfinance exposure at 10%. They're sacrificing high-yield volume to avoid compliance shocks. While chart patterns signal a technical breakout, the drag of acquisition costs and regulatory oversight will likely cap short-term explosive momentum. To calculate a final verdict, we model 3 distinct forward scenarios. In the bear case, the deposit war stalls advance growth, the cost of funds escalates, and the bank's return on assets remains below 1%. In the base case, management successfully executes their 20% advance growth guidance over the next 3 years. Legacy provisions fade out of the system, and the exit ROA settles into a range of 1.2 to 1.3%. Finally, in the bull case, the bank sustains operational execution and secures a universal banking license from the RBI. The ROA hits management's 1.5% target, triggering a valuation re-rating that pushes Equitas' multiples up toward AU Small Finance Bank's levels. Building a 5-year return projection requires strict math. Targeting a 15% compound annual return on the stock requires significant underlying business performance to justify the entry price. With a high trailing PE ratio, the underlying earnings engine must accelerate. Net profit must catch up to the price investors pay today. If the base case holds and growth hits 20%, a gradual price-to-book re-rating offers sustainable upside as the market digests the cleaner balance sheet. The financial turnaround is complete. Asset quality is stabilized, the pivot to secured lending works, and institutional backing is solid. Equitas is a candidate for a gradual buy-on-dip strategy for patient capital. However, because current multiples leave little room for operational errors, aggressive lump sum allocations should be avoided.